Good morning, good afternoon, and good evening. I'm Keesa. Increased wage inflation has released liquidity into the market, and this factor, along with the transference of wealth, has many asking, where should I invest? Environmental, social, and governance, or ESG investing, is gaining tremendous traction in this environment. Investors injected approximately 33.6 billion into socially responsible investing, or SRI, as well as ESG focused mutual funds and ETFs during quarter one of 2021 alone. Now, joining us today to give insight on wage inflation and possible implications for ESG investing is Senior Vice President and Senior Portfolio Manager at AllianceBernstein, Valerie Grant. Valerie, thank you so much for joining.
Oh, it's a pleasure to be here. Thank you for having me.
So, Valerie, what is wage inflation exactly, and how can it be a driver specifically for the S, or the social aspect of ESG investing?
Well, wage inflation really refers to rising wages. It is literally what it sounds like. And what we've seen is that during the COVID pandemic, many companies decided to pay additional wages or one-time bonuses or enhanced benefits to their employees. And essentially, those increases have become permanent. And in addition, in particular sectors, the services sector, as an example, some aspects of trucking and transportation, what we're finding is that employers actually have to pay more to motivate workers to come back into the workforce. And I think that that is a function of the recognition of some of the risks associated with work that requires that you have constant interaction with the public. So when you think about wage inflation, it's not all bad. So there are some companies, when they experience wage inflation, they're able to pass those costs on to their customers, right? And so it doesn't necessarily mean that their profitability is going to decrease. And there are other companies who actually don't have that capability. So it'll be interesting as we make our way through this current earnings season, what we hear from companies in that regard.
Great. And thank you also for joining us during this busy earnings season. I know it's especially busy for you. And just keeping along with the thought here around environment, especially, we see lots of data around environment and corporate responses to the E part of ESG, greenhouse gases, emissions. These all have quantifiable data points attached to them. Are we beginning to see a greater S, our social data aspect? And would you say that there are certain regions that are driving what we're seeing now?
We're definitely starting to see better corporate disclosures on S issues. And in addition to that, there are other sources of data on a company's performance on the S dimension of ESG as well. So take as an example, pay equity. It really started with the UK and the legislative mandate that companies report their pay equity data for their operations in that particular country. And so once you have visibility and transparency in one specific country or one specific region, investors then can ask, well, is this true globally? Or how is this market representative? So oftentimes it's led by a particular region. In the US, we see in California, there's a requirement now for more board diversity. So again, I mean, most companies, they operate across the United States and they operate globally, right? And so if one particular market sets a higher bar, then they generally begin to meet that bar on a global level. We're also finding that due to the advocacy of many investors, companies are beginning to disclose their diversity, equity, and inclusion data through the EEO-1 form that had historically not been available at all to investors. So the transparency and the data is really improving.
And Valerie, you just mentioned a little earlier a bit about the corporate governance piece. And we're talking before about Exxon and the new board members resulting from investor engine number one's engagement a couple of months ago. So Valerie, what's different about the way activist investors specifically are engaging corporate boards now versus a decade ago? What's changed to really enable what we're seeing now?
I think that the entire landscape has changed, and it's not just restricted to quote unquote activist investors, because all asset managers, whether you are an active manager or a passive manager, we're all playing a much more active role, actually, as shareholders. And you see this reflected in a number of ways. One is in company engagement. Obviously, you have, Larry Fink at BlackRock, publishing his letter to CEOs. That's one way to do it. You can be very public about your concerns. Two, as is the case with AllianceBernstein, we have very strong access to CEOs and CFOs of public companies, and we engage them on these ESG issues with as much rigor as we do on their financial performance and their financial outlook. And then also you see it in what's coming up in proxy season. There are many more shareholder proposals being put forward, and they're gaining support. And so I don't think that the Exxon example is a one-off. I think we'll start to see more examples of this going forward if investors are not satisfied with the pace at which companies are addressing their concerns.
Wow. So pace is really important here, obviously.
Yes.
We welcome questions from our audience. So feel free to reach out to us via the chat, via the comments, to send your questions into us. Meantime, Valerie, what other mechanisms could be put in place to really increase company disclosure? So you mentioned a few of them here. Proxy season, more shareholder proposals really gaining momentum and support there. What else are you seeing?
Well, there are actually standards for disclosure. SASB, which is now the Value Reporting Foundation, has published standards for disclosure by sector and subsector. And now with the merger of that organization with an international standard setting body, I think you'll start to see a lot of consistency in terms of what global investors would really like to see companies disclose about their environmental, social, and governance practices. And so if I were the CEO or a CFO of a company, I would say, okay, well, let's get those standards as a basic framework and start from there. And then let's focus on what's our business strategy? What are we seeking to accomplish? How do we deliver value? And then now let's figure out what's most material from an investment perspective and begin to push that data out to investors so that we can track their performance and their improvement, ideally, on those metrics.
So you mentioned earlier the passive model and the active model, and I guess how, but they both have been impacted. When you look at the global investing landscape, do you see specific impacts as it relates to ESG investing if we're looking through the passive lens versus the active lens? And can you give us some thought about where you see the near-term future going there from both lenses?
Sure. So I think that ESG or responsible investing really affects all asset classes, whether you're passive or active. And so if you look at professionally managed assets, in reality, actually, the private markets have actually grown as a percentage of the total relative to fixed income and equities that are traded publicly. So that's one phenomenon. And so what you're seeing is that even in the private markets, there's a lot more emphasis on ESG and sustainability. And so private equity funds, venture funds, all types of alternative asset providers are also focused in this area. When you look at public equities, historically, the penetration of passive in this market has been very low. But what we're seeing are more differentiated ETFs, and those are gaining some traction. The one challenge I would point out is that they're often based on third-party ratings, which can sometimes be backward-looking. So what we try to do is to have a forward-looking view on how companies are likely to perform and to try to identify those ESG issues that are not already priced in. But I think that there is room for all strategies across asset classes when it comes to responsible investing.
So, and when you're talking about strategies across asset classes, one thing we didn't touch on here is the infrastructure conversation. I know this is a lot of this is fixed income oriented, but if we're looking at what's going on in the U.S. and what we see going on in other areas around infrastructure, around building out this type of sustainable infrastructure, bridges, roads, etc., do you see an impact that could really cross asset classes, or do you feel that that's going to be primarily a fixed income play as it relates to the infrastructure build out that we're seeing in the US as well as in other areas?
I think you'll see opportunities across a variety of different asset classes. Obviously, in the fixed income market, as people issue green bonds, there's a significant opportunity there because you can actually tie the use of proceeds to those specific projects. We saw the other day, I believe it was Carlyle just launched a new infrastructure fund, focused on environmentally friendly projects. So you're seeing it in private markets, in the fixed income market, and then on the public equity side, there are opportunities to invest there as well, because many of these companies are public, right? So you can actually buy the equity. So I think you can play it at every level of the capital structure. Yeah.
And Valerie, what steps do institutional investors take when considering how to drive forward the ESG agenda? And I'm thinking specifically about the role that data is playing right now and access to the right data, the role that it's going to play. What do you see happening? What do you think the right data looks like? And how do you see that really driving and helping investors to drive the ESG agenda forward?
Well, there are a couple of, mechanisms by which market participants are looking for greater transparency. So the first is that investors, whether you are a shareholder or you're a creditor, you're looking for greater transparency from the company, right, about their performance so that you can assess either the return potential or the credit worthiness of the issuer. And in addition, asset owners are looking for more transparency from asset managers about how we're evaluating companies and are we truly doing our due diligence when we say that we're investing with the focus on ESG. And so there is an emphasis on transparency and data at every stage of the value chain and across the ecosystem, if you will.
Great. So, lots of great information here. First of all, really love the advice for the corporates here. We continue to see standards for disclosure, consistency around what global investors are looking for is going to be key. And so maybe corporates, board members, C-suite folks should ask, what is our business strategy? What's most material? And really push that information out to investors. You talked a lot, Valerie, about how investors are playing more active roles as shareholders. Corporate and company engagement is one area that you mentioned that AllianceBernstein is doing right now. Also, we're seeing what's coming in proxy season. More shareholder proposals are really gaining support. We talked a lot about that, as well as really emphasizing the transparency of what we see and data being an important component there. Valerie Grant, Senior Vice President and Senior Portfolio Manager at AllianceBernstein. Thank you so much for coming, especially during this busy earnings time, Valerie.
Thanks for having me. It's my pleasure. Thanks so much.
Thank you.
All right.
And thank you to our audience, as always, for joining us. If you enjoyed today's episode, which I know you did, you can download a recent report exploring myths around the S in ESG by following the link in the comments or scanning the QR code on your screen now. This is Keesa Shreen. Thank you for joining and be well.